All right, for all you banking exam aspirants out there, this one is for you. The RBI has new rules for small finance banks, and you're going to need to know them inside and out. These regulations on capital market exposure kick in on April 1st, 2026, and we're about to break down everything you need to master this topic.
Okay, so here's our game plan to make this super clear for your exams. We'll start with the key definitions, then dive into the specific ceilings. After that, we'll talk about the general lending rules, see how they apply to individuals and then to intermediaries. And finally, we'll wrap it all up with the key takeaways you absolutely need to remember.
All right, first things first, we've got to build our foundation. In this first section, we're going to get a really firm grip on the key terms and the specific language the RBI uses in these new directions.
So, you might be wondering, why regulate this at all? Well, it all boils down to one simple word: risk. Capital markets can be pretty volatile, and the RBI's #1 job is to keep the banking system safe. So they do that by setting very clear limits on how much of this risk the banks can take on.
First up, what exactly is this capital market exposure, or CME? Well, it's a really broad term. It's not just about a bank buying stocks directly. It also covers indirect stuff, like lending money to someone using securities as collateral or giving loans to stockbrokers.
Next, we have capital market intermediaries, or CMIs. Just think of these as the big SEBI-regulated players. Your stockbrokers, clearing corporations, custodians. Now listen up, here's a classic exam trap. For the purpose of these rules, mutual funds and AIFs are not considered CMIs. Remember that.
You're going to see this acronym LTV pop up a lot. It stands for loan to value. It's really simple. It's just the ratio of how much you're borrowing to the market value of the stuff you're putting up as collateral. It's a key tool the RBI uses to manage risk.
So, what can you actually get a loan against? Well, here's the list of eligible securities. And to help you nail this in the exam, we've got a great mnemonic for you. Good students can do Masters in Economics and Research. That covers government securities, shares, commercial paper, debt securities, mutual funds, ETFs, and REITs. Pretty handy, right?
All right, buckle up for Section 2. We're moving to the absolute heart of the regulation, the Prudential ceilings on CME. This is where we get into the numbers you absolutely have to memorize.
The first big number to etch into your brain is 40%. Think of a bank's Tier 1 capital as its core financial safety net, right? Well, its total capital market exposure, that's everything, direct and indirect, cannot be more than 40% of that safety net, based on the previous year's figures. And within that overall 40% limit, there's another rule, a sublimit. The bank's direct investments, things like actually buying shares or equity mutual funds, can't go past 20% of its Tier 1 capital.
Now here's a key detail. How are these 40 and 20% ceilings actually applied? Well, they're applied in two ways. They apply to the individual bank on a solo basis, and they apply to the entire banking group on a consolidated basis. Think of it as a double check to make sure everyone is playing by the rules.
Okay, lean in for this one, because this is where they try to trip you up on the exam. These are the key exclusions from the CME ceilings, and if you look closely, you can spot a pattern. Things like investing in critical infrastructure like NSDL are out. And notice the emphasis on debt. Loans against debt mutual funds and non-convertible debentures are excluded. All right, moving on to Section 3, General Lending Principles. Think of this as the main rulebook, the fundamental do's and don'ts that small finance banks have to follow for any lending that touches the capital markets. The RBI is really laying down the law here. They're trying to prevent any high-risk situations. For example, banks are flat out prohibited from lending against their own shares, or partly paid shares, or anything that's in a lock-in period. The whole point is to avoid conflicts of interest and to stop banks from funding speculation. Okay, let's switch gears. In Section 4, we're focusing on how all these rules affect regular folks. These are the regulations for retail borrowers, people like you and me. This table right here is absolutely crucial for your exams. It spells out the maximum LTV ceilings for individuals, and you can really see the RBI's logic. The LTV is lower, just 60% for more volatile things like shares, but it's higher at 85% for more stable assets like debt mutual funds. The riskier the asset, the less you can borrow against it. Makes sense, right? Okay, get your notebooks out because these are the exact rupee limits you need to know for individuals.
There's a big overall cap of 1 crore rupees per person for loans against securities like shares. But inside that, there's a smaller cap of 25 lakh rupees for specific market activities, like applying for an IPO or buying shares directly from the market.
So we've covered individuals. Now in Section 5, let's zoom out and look at the bigger players, the capital market intermediaries and other companies. The rules here get just a little bit different.
So, for the pros, the RBI uses a different term, haircuts. Now don't let it confuse you. A haircut is just the flip side of LTV. It's the percentage the bank reduces from the market value. So a 40% haircut on shares for a broker is basically the same as a 60% LTV for an individual. It just shows the RBI is a bit stricter when lending to market professionals.
And when it comes to giving out guarantees for brokers, it's all about the 50-25 rule. Super easy to remember. The bank has to take a minimum collateral of 50% of the guarantee amount, and at least half of that collateral, so 25% of the total, has got to be in cold, hard cash. It's another important way to reduce risk.
All right, we have covered a ton of ground. Now, for the most important part, let's boil it all down into your final revision checklist. This is what you need to review right before your exam.
First up, the core concepts. Let's run through them real quick. CMA is both direct and indirect. CMIs are your brokers, but not mutual funds. LTV is loan to value. Don't forget our mnemonic for eligible securities. And of course, the effective date, April 1st, 2026. These are the absolute fundamentals.
And here it is, the slide you'll want to screenshot. This has every single critical number you need to know, all in one place. You've got the 40 and 20% ceilings, the 1 crore to 25 lakh limits for individuals, the key LTVs and haircuts, and of course that 50-25 rule for guarantees. This is your ultimate cheat sheet.
And that really brings us to the big question, doesn't it? As these small finance banks continue to grow and play a bigger role, how will these new guardrails shape their future? It's a fascinating balancing act between pushing for financial inclusion on one hand and ensuring rock-solid financial stability on the other. Definitely something to keep an eye on.